In venture capital, protective provisions are specific clauses in a term sheet that give investors the right to approve or veto certain company decisions. These provisions are designed to protect investor interests, ensuring that major corporate actions cannot take place without their consent. Thus, understanding how they work and negotiating them wisely can help prevent founders from making unilateral decisions that could significantly alter the company's risk profile or capital structure while maintaining the right balance between investor oversight and founder autonomy. When investors provide funding, they're betting on the company's success, but they also want to protect their investment from unnecessary risks. Since startups are high-risk, protective provisions give investors some control over key decisions that could affect the value of their investment. For example, these provisions can help prevent reckless spending, excessive dilution, or decisions like selling the company or taking on debt without investor approval. They also help ensure that preferred shareholders have certain rights over common shareholders. Without these provisions, founders could make significant business moves, like raising a risky round of funding, selling the company at a low valuation, or issuing too many stock options without input from the investors. While investors don't run the company, these provisions act as a safeguard, giving them confidence that their capital is being managed responsibly. It's all about finding a balance where founders maintain control, but investors have enough protection to feel secure in their investment. Protective provisions are clauses found in a term sheet that give investors a voice in certain business decisions. These provisions are designed to ensure that investors are not left out of the loop or placed at a disadvantage during pivotal moments in a company's growth. Typically, these clauses require investor approval before specific actions can be taken. One of the protective provisions most frequently used is the restriction on issuing new shares or securities. This often includes anti-dilution protection. Investors generally want to approve any issuance of additional shares because they do not want their ownership diluted unfairly. This applies not only to future funding rounds, but also to stock option grants and convertible securities. Another common provision involves the sale of the company. Investors usually require their consent before the company can be sold, merged, or participate in an acquisition. This helps prevent a situation where the business is sold too early or at a valuation that favors the founders without delivering strong returns for the investors. Changes to the company's capital structure are also often subject to approval. This includes actions such as taking on large amounts of debt or issuing dividends to shareholders. Investors want oversight in these areas to ensure the company does not become over-leveraged or begin distributing profits at a stage when reinvestment would be more appropriate. Significant changes in founder salaries or compensation may also trigger investor review. Investors want to ensure that executives are not drawing excessive compensation, especially if the financial stability of the company could be affected as a result. Approval rights are often extended to changes in the company's governing documents. This includes the company's bylaws, charter, or equity structure. Investors want to maintain clarity and consistency in how the company is governed and ensure that critical rules are not changed without their input. Finally, some term sheets include provisions related to major business changes. These can include restrictions on pivoting the business model, altering the company's mission, or shutting down the company without investor approval. These clauses are intended to give investors a say in major strategic decisions while still allowing founders the freedom to manage daily operations. In essence, protective provisions strike a balance. They ensure that investors are involved in decisions that could significantly impact their returns, but they are not meant to interfere with the founder's ability to run the business on a day-to-day basis. Both sides benefit when these boundaries are clearly understood and respected. Protective provisions are a standard part of venture capital deals, serving as a critical mechanism for investors to maintain oversight and mitigate downside risk. While founders may see these clauses as constraints, from the investor's perspective, they are essential to preserving the value of the investment and ensuring responsible governance. As a VC, it's important to avoid provisions that are too narrow to offer meaningful protection or too broad to be enforceable without disrupting company operations. Well-drafted provisions strike the right balance. They allow investors to block major decisions that could adversely affect their stake, such as changes to the company's charter, new financing rounds, asset sales, or changes in control. without micromanaging the day-to-day execution. Investors should also be mindful of pro rata power dynamics. While it's appropriate for major investors to have significant rights, giving smaller shareholders the same level of control can lead to fragmented governance and operational delays. Ensuring that protective rights scale appropriately with ownership and stage helps avoid unnecessary friction and preserves board and management effectiveness. In sectors where speed is critical, too many layers of approval can slow the company down. That's why thoughtful VCs focus on key strategic vetoes, not operational interference. Protective provisions should safeguard core investor interests while allowing founders the autonomy to execute swiftly and decisively. Protective provisions are negotiable, and investors should aim to strike a balance between securing their interests and allowing the company to operate efficiently. There are several strategies VCs can use to structure these provisions effectively. One key approach is to focus protective provisions on major decisions. Investors should ensure they have oversight on high-impact actions, such as acquisitions or mergers, while allowing founders to handle day-to-day operations without excessive restrictions. This helps maintain a productive working relationship while safeguarding investor capital. Another strategy is to establish approval thresholds. Instead of granting veto power to a single investor, requiring approval from a majority of preferred shareholders ensures that decision-making remains collaborative and prevents any one investor from holding up critical actions. It's also essential to define what qualifies as a significant decision. Protective provisions should apply to material changes, such as strategic pivots or large capital raises, rather than minor operational adjustments. This allows the company to remain agile while still protecting investor interests. Lastly, incorporating time-based adjustments can be beneficial. Some protective provisions can be designed to phase out after a set period or once key growth milestones are achieved. This ensures that investors have strong protections early on while granting the company more autonomy as it matures. By structuring protective provisions in this way, investors can mitigate risk without stifling growth. The goal is to maintain the right level of oversight while fostering a partnership that allows the company to scale successfully. Protective provisions are essential in venture financing because they give investors a way to safeguard their capital while still allowing founders the freedom to run the business. The best deals are those that find a balance where investors feel secure in their rights, but aren't overly involved in the day-to-day operations. Founders should be able to maintain control over daily decisions, with the understanding that major moves, like acquisitions or raising more capital, will require investor approval. Both parties should be aligned on the long-term vision for growth and the exit strategy, so everyone is working toward the same goal. For VC, it's key to understand these provisions early on and negotiate when necessary, making sure they don't restrict future fundraising or limit the flexibility to pivot if needed. At the end of the day, the strongest venture capital partnerships are built on trust and mutual respect, not just legal protections. When both sides strike the right balance, they can move forward confidently with a clear path toward success.